first talks in Chennai with an audience which is very enthusiastic, very eager.
Can you check it, sir?
Okay.
Green light.
Yeah.
So, you'll excuse my inadequacies, whatever they are. I have put together a very rushed presentation. It's slightly unfocused because I like to ramble a bit. Unless there's an interactive question and answer session, it may not add too much value to you to that extent. And I take a very casual approach to investing. So I must confess that I cannot be as precise as Patu sir or Subra or any one of those people are. So I am a fringe investor, if I may call it. What I like to do is I like to observe, I like to comment, and what I actually do in life will be very different from that. I have two compartments for my stocks. One is I trade without knowing, and the second is I invest without knowing. So, and I am 60 now, let me tell you that. I think I am comfortable. I am very grateful. I think I have far more than I deserve. Far less than what people think I have. So, and God has been very generous. My children's education cost me virtually nothing. I think not even 10% of the amounts which purchased put in. They were lucky to go to good universities which the fees were nothing.
They're doing a PhD.
Huh?
They're doing a PhD.
They're doing a PhD, so they will be earning. Okay.
My education didn't cost much for my parents.
Exactly.
Same reason.
Same reason. So, and my education also was 125 rupees. That was the first fee I paid. After that, I got my scholarships and every fee was reimbursed. So I have been very, very lucky and privileged. I like equities for the simple reason that there is no right answer discovered in the world yet. I think every day hundreds of books and blogs keep getting written, and everybody is still trying to find the holy grail. So don't think that this is the last word in investment. There will be far better people who will come and talk to you, far worse also, and we will, by the time we know all that, we already made our mistakes. I always think that wealth is something which is beyond our savings and lifestyle. I think what you are doing as financial planning is really to give a kind of an insurance to your basic needs. I think the lifestyle traps or whatever you want, to me that falls in the realm of savings, not really investment. To me, investment or wealth is far beyond something which you take beyond your lifestyle to do good for others or to pass on to your children depending upon your own ambitions or approaches. And I think the best tool for wealth creation is equities. So when I talk about equities, I am talking about 100% of the money which comes to equities. I am not talking about asset allocation. Asset allocation is again very fundamental and different to each individual, depending upon the circumstances in life. If my father has already left me a house, then my biggest hurdle in life is crossed. And today, if you look at the economics, I don't know how many people really want to own a house. Renting is far cheaper. You keep money in the savings bank. The interest on that will be half to pay your rent, and the half you can create the retirement purpose with that. Just think seriously about that. And I always look at equities for investment as not buying a share. It's like, do I want to own the business? I think this is independent of what I learned from Warren Buffett. I discovered Warren Buffett's writings and all in circa 80s. But before then, I think the shares, the mind was always like that when I buy a share, I am a co-owner. So I take that approach always.
So when did you first buy a share?
This was 1980, somewhere in 80. We had the IPO lottery.
Yeah.
So you had to buy, if you got the lottery, you made it big. 100 to 1,000 rupees became 11,000 rupees. When I went to that place and I found there had no land for the factory, I sold it and bought more shares. And looking at investment, there are so many approaches which people will tell you. I think all of them are equally confusing. We talk top-down approach. Top-down approach is the easiest thing to talk about because I can bullshit for 3 days. Because it means how is the economy doing, how is this, then you go on to petrochem, how is US, how is BRICS. So I think none of us are equipped to do that really. But you have a general sense, yes, things are doing well or not. Bottom up, yes, I like the approach because I like to look at what the company is doing. I go straight from that. So that is one approach I like to take. The other thing I like to remember and keep in mind are business cycles. As an investor, I like bad business cycles. Because I think that's the only time we can actually look at buying something. In a very bullish environment like this today, I do not find a single value buy. And I don't believe in relative returns. I think this is something which is peculiar to me because I look at money as something which normally would lie in the savings bank. Today in the liquid fund, probably it's more tax efficient. So anywhere else, if I have to shift my money, I look at what kind of return, how much superior. To me, it should be at least 2x. So if I take a 2x risk, that means I am looking at 15-16% return on a single equity share I put into. And I know out of 10 I put, maybe 2 or 3 will go. And focus. See, all of us spend maybe 12 to 15 hours earning our money. What I always tell people is, why don't you spend that 1 hour a day trying to learn one subject where you can get better and invest your money so that you get your 3 crores or 7 crores of purpose daily. We don't want to do that. We want to go and trust a financial planner. We want to trust an advisor. I'm not saying don't trust them. But you do your work, it's your money. He is not accountable or answerable to you. And when you are focused on something, don't let the noise bother you. That's the other thing, I will explain that in detail. And lastly, I have a process, I have a method for analyzing shares. I keep improvising it, improving it, but I never buy a share without passing it through process and method. Not because I am going to be right always, but I will know that there is something flawed with my process when mistakes happen. So I can improve my process. And stock market is a very funny place. When you are going to invest, you are alone. There is nobody with you. There is only noises. There are 999 buy recommendations compared to 1 sell recommendation in the market. So if you go by the noise, you will end up buying everything. So then popularity contest. You don't want to go and talk in public saying that I own Infosys, I own TCS, what do you own? It's not a popularity contest. And there is an efficient market theory. I don't know, it says everything is in the price, the market knows everything. I call it efficient market theory. If the markets are efficient, trades would not take place. Because everybody knows everything, so buying and selling would happen only if there is a need for somebody to sell and make money. And of course, as you say in the car, objects are closer than you think on your rear view mirror. We should not have a rear view bias. You learn from history, but do not be biased saying that, oh, this share once I bought and sold, I point my fingers, so I will never look at that share. So this is something, there should be no bias in investing. And bubbles. See, bubbles are very interesting thing. Bubbles means that stocks have gone way beyond their intrinsic value. So according to statistical measures, bubbles happen once in 6.25 years. But in reality, it happens almost every 3 years. If you take statistical measures of our NSCP or whatever some measures are, you will see that probably P of 22 is a median for the National Stock Exchange. So what it means is, it doesn't mean that it cannot cross 22. What it says is, when it goes to 25 or 28 and you are investing, your prospective returns are going to be lower. So use bubbles to your advantage and don't get emotional about stocks. I think saying that I love this company, so at any price I won't sell, then you will again lose it. And the opportunity cost of money for me is simply the liquid fund money, nothing else. Not real estate, not anything else. Let me then quickly shift to a balance sheet analysis. How many of you are read balance sheets? Very few, very few. Okay. Let me try to simplify a balance sheet. You have two sides, the assets and the liabilities. So you have assets which are necessary to run the business, which will include fixed assets like building, plant, machinery. And you have current assets which are basically your inventory, your debtors, your 1 month payable of salaries, electricity bill and all those things. And how do you fund them? You fund them either with loans, creditors and owners' money, which is your shareholder money. So this is the rough structure of a balance sheet history. And what is the purpose behind investing? The basic idea is that every rupee invested has to return some money to the shareholder. So that is the real objective. So there will be companies which can be most of the companies existing in India can be categorized into two broad categories. One which earns on assets, I call them smokestack industries, cement, steel, automobiles, all these things. Because you have to create that facility and after that production is automatic. So it doesn't depend on anything else. So the value of that business really lies in the production facility. There are other companies which earn on brand, services, everything, which are asset-like, like the FMCG, pharmaceutical companies. They also have plant and machinery and things like that. Or banks, insurance companies. They are all very, very asset-like. So you can actually divide these two to look at how to value a company. Now, if you look at all the cement, steel or chemical companies, their earnings are fairly predictable. Their earnings go up and down because depending upon the demand supply for the commodity, whether China buys more or India buys less, whatever. And most of the companies are comparable to one another. And entry barriers are not at all high. Anybody can set up a cement company, anybody can set up a steel company. I'm not talking about artificial barriers of licenses and 2G or 3G, those kind of things. Okay. And here how one builds a profitable business is by economies of scale in production, distribution, marketing, everything. And there is very low differentiation. The cement, somebody might say 43, 53, ultimately it's cement. When you build your own house, you don't know, you don't actually go and choose which cement you are using. You might like to say, I want Ambuja, I want Madras or whatever. But it's all the same cement. So these are all commodity companies. How do you value them? You value them at replacement cost. How much would it cost for somebody to set up a similar plant? So how do you use this as an investment tool? It's very, very simple. Enterprise value is basically the market capitalization of the company plus the debts it has. So that is the value which is given to the company, enterprise value. So if that value in the market is far more than setting up a new plant, should you buy the share or not? Yes or no?
No.
No, okay. Same. So when do you get an opportunity when the market cap actually crashes? It is when it goes into a slump. Cement demand falls to 20%. The PE goes from 50 to 500. That is when probably you buy those. So use replacement cost. I like to use replacement cost as a simple measure for. So that's my broad skeleton for analysis. And replacement cost, if it is less than replacement cost, I'd like to buy. So that gives me a margin of safety also. That when I buy something below, so this kind of opportunity do you get every year? You don't. You probably get once in 8 years, 10 years, once in 15 years. You will get this opportunity. That's the time you buy. And when there is a bubble where it trades at, when the 1 ton of cement plant trades at 3 tons its value, I think I would like to sell and wait for the next round. This is where wealth can be really made. These are all your Infosys, your TCS, or Hindustan Lever, or any of those companies which are asset light, where the turnover divided by fixed assets is so many times, 5 times, 10 times, 20 times. If you take a cement or a steel plant, the turnover will be 1 to 2 times the investment on the ground. So here, what kind of businesses do you choose? You choose companies which have a moat around their businesses. Like a castle with a moat, it doesn't allow anybody to come in so easily into the castle. So these are companies which have built brand over years because either they have a superior product, or they have a great distribution strength, or they simply have established the brand over so many years. So you will have companies like a Lever, ITC, Nestle, Colgate, all of them which have established kind of a semi-moat. I'm not saying they have a very hard moat. There are very few businesses in the world with hard moat. These are semi-moats, I would call it, because anybody else can make a toothpaste also. Today I know so many people are buying Ramdev's toothpaste. So there are no entry barriers in that sense, but the brand which they have created is a phenomenal one. And how does that translate into a better business? This is where I think I would like to imprint on each of your mind one single ratio which you should use if you don't have the time to analyze people. This is the return on equity. See, why do I invest money into your company? I am saying that on the rupee I invest with you, how much do you make? I have an option of keeping it in the bank. The bank will give me 8 rupees. So the ROE on my 1 rupee is 8 rupees. Now, if I look at the balance sheet of Hindustan Lever or Colgate, on the net worth, which is the capital plus reserves, or in other words, the book value per share, if you can take it. I take the PAT and divide it by the net worth, which gives me a number saying that this is the return on equity. If I look at Hindustan Lever, last 5 years it has given more than 100% return on equity. It means for every rupee of shareholder money, every year it has earned more than a rupee. There are very few businesses like that. It is not that every business makes money. But if you take the Bombay Stock Exchange or the National Stock Exchange listing, there are 6,000 companies, 3,000 which get traded. There are only about 100 or 150 which earn more than 25%. So, this is where I would really like to get.
Return on equity.
Return on equity is profit after tax, which is the money belonging to the shareholders. The money invested by the shareholder is the capital plus reserves or the book value. So EPS divided by book value will give you the return on equity. Like if you invest 100 rupees in the bank, at the end of 1 year they give you 108. So your equity was 100 and the return was 8. It is a very similar analogy. Fine?
Sir,
Yeah.
what's the difference between ROE and ROCE, sir?
See, I think that gets a little complex. What happens is ROC, the capital employed, is own money plus others' money. Correct? Others' money is the lender's money. So I take the PAT and I add the interest to that. Because I have paid them the interest. So I add it, plug it back. So then I get the ROCE. And because of tax reasons, we take PBT plus interest divided by own money plus borrowed money. So what it says is, if I am in a business where I have to borrow money, the return on my business should be more than what I pay the lender. Like, for example, if you take a company like Reliance Industries, last 5 years, it has not earned more than 11% on the shareholders' money. To me, it is a very, very dull business. It doesn't make a difference. I wouldn't like to be in that smokestack industry at all. It is a trading opportunity. Maybe I'll buy it at 700, sell it at 900. It looks that way. But is it going to be part of my wealth creation? No. So, sorry?
Even though we are talking about general equity, right? So that is about the business, but price is different, right? Share price is
Share price will be different. So that we will come to that. I am saying what is the conditions before I marry. I want the bride to meet these conditions. After that I demand like how much is the dowry, how much is the thing. Let us come to that. Okay, so I am saying these are the characteristics which I look at. I look at this. Okay.
so this is average for last 10 years.
I normally like to take 10 years.
10 years.
10 years, yes.
Either to the replacement cost or the ROI should be, these are the different rates.
Sorry?
First was the replacement cost, second was this ROI.
Second was this is applicable for across the world. Across. If you take a replacement cost, I normally don't like to invest in commodity companies. But if I see a trading opportunity, I like to see whether it is below replacement cost.
The FMCG after the commodities, right?
The FMCG is not, that is what I am saying. They have built moats around their business. See, why is Hindustan Lever growing like this, or a Colgate growing like this, or a Nestle growing like this? Or you look at services, TCS, and HDFC Bank. Okay, HDFC Bank will not have this 25% ROE. It is more a fake premium you end up paying for that stock. But essentially, what the heart of any business is to make money. Okay? So the single best measure is the ROE. So I don't know what you make, but if 10 years you are delivering this, there is something good you are doing. So that is why ROE becomes important. And how to evaluate, I think that's a very complex thing, but I will take you through that also to some extent.
Sir, you talked about RL as an example. You said you will not invest. But if you look at ROE, it's based on what they are earning today, but they are also investing into new business.
No,
How do you value those?
In 10 years, if it has not delivered, I don't want to look at that. Let them deliver, then I will look at them. So last 10 years also they said they are investing more and more.
Exactly.
As it translated, if they are going to continuously keep investing in non-earning assets, it's good for them. They are treating the money as venture capital. But then,
That way, airlines and all are running losses since inception. How do you?
I don't invest.
Classic.
I don't invest in most transport businesses. See, we have some monopolies like Bajaj Auto, which grew up of the licensing. So they were lottery businesses. And in India, I think as an emerging economy or this growing purchasing power, automobile still has some glamour left. But if you look at globally, General Motors, anyone like that, they are trading at 5 times, 6 times peak earnings. So it's not such a hot, and they don't earn this kind of ROEs. ROEs in this kind of businesses will gradually decline.
So you only look at ROE while investing in your.
That is the starting point for me.
So that filters out all these other
I
companies.
have on a company about 11,000 checkpoints. 10 years. So let's not get into that. But you see, this check, once it passes, more than 50-80% will come into the investment zone.
But the investment zone is very small.
It is small. But ultimately, how many stocks do you need in your portfolio? Do you want to rival a mutual fund portfolio?
How many you have, if I may ask?
I have about 9 stocks.
Sir, can you go through again that replacement cost on the previous one?
Yeah. The replacement cost is, for example, simple. If I have to set up, I am making this hardware for this computer. Now, I can make one PC at 100 rupees of machinery. So my capacity is, let us say, 100 pieces. So my investment is 10,000. So if my market cap falls to 8,000 rupees, it is attractive for somebody to buy. Clear? And if I already have some debt, you reduce that. So debt plus market cap is what is actually goes into it, the enterprise value.
So one more thing, you picked up a stock that was consistently giving ROE, and after a few years it starts to go down because there is some capital expenditure,
Right.
some diversification. How long? What is your patience level? How long you wait?
No, I like to keep looking at them every month at least to see what is happening, whether there is any bad news, good news, and are there any trends which are changing.
Yeah.
See, it's like, I think like Nestle, I think Maggie is a good opportunity, but the price is not cracking.
Correct.
Cracked only by 8 or 10%. If people got disheartened and cracked by 50%, I will put my house on it. How many of us remember the worm in the Cadbury?
Yeah.
We are still buying it. So something like Nestle, which has got 5 products, 6 products, one of the products has got damaged, which will become high profile thanks to the media we have, the Twitter, the Facebook, and everything. So in 2 years, 3 years, it will die off. So if the price unfortunately did crack, it is still at 44 PE.
Sir, do you have a take on oligopolies?
Sorry?
Companies that are, for example, paints. There are only about 3 or 4 of them. So the market is.
I think ultimately the market does go into 3 or 4 players only. There used to be the role of 3, now there is a new book called rule of 4. So ultimately it does become like that because if you have that dominance, you will be a market leader. So all these high ROE companies are market leaders in their spaces. You can have a high ROE when you are very young or when you are mature. So I am looking at companies which are mature and things like that. And since I am looking at pure wealth, I am looking at companies with 10-year history. So there are a lot of misses which we will do because I am not looking at the young ones, the new ones which come up. So because that is like you are funding a investor for a venture capital. See, in India there is a lot of opportunities in these new spaces, but out of 10 you put, how many of you will be winners in that? It is good to read about somebody putting money in a Western India vegetable product share in 1960. At that time he was selling Umda, who wanted to buy a company? It is now Azim Premji's Wipro, isn't it? The next step after I identify the companies or make a short list, I like to see what are the broad parameters. I'm not going into Excel spreadsheet analysis. I have 2-3 companies which I can show to you what a broad analysis can do. Is I like to look at this cash flow. Cash is real in spite of what happened at Satyam. Okay, there he proved that you can have fake cash on the books also. Okay. So cash flow, what I mean is whether the current asset, I look at the profits. The company may be growing its profits, but it may be increasing its, for example, debtors far beyond the profits are growing. So its cash flow actually gets negative. Or it may be borrowing more to grow more. So those are the kind of things which I look at in a cash flow. I would like companies to be cash flow positive. Means after all the change in working capital, after normal capex and everything. If you put capital expenditure into account, the Reliance Industries cash flow is constantly negative.
Sir, what you mean is free cash?
Free cash. Okay. I use very basic terminologies.
Smart.
Okay. Management competence. Now, how do you judge management competence? It's a it's only a relative measure, not an absolute measure. And relative measure, I don't mean number of relatives on the board. So, which is, I think the norm in east of Europe, I think we tend to be family-owned companies. There is nothing wrong in that. I think in TVS, I remember the joke used to be that after the interview, the senior person would put a hand around your shoulder and walk you out. You feel very happy that he was actually testing whether your owner is there or not. management competence, the best measure is actually spoken of by the numbers. Is the ROE constant, growing? Has there been more than 1 or 2 bad years? So that is where I look at as the indicator of management competence. You don't have to know everything about a promoter to actually make a comment whether it's good or bad. It's like a company called Vardhaman Textiles. I don't know how many of you know even the name of the promoter, but I look at the numbers, it's outstanding year on year. Okay, that he is in a business which nobody likes, so the share has never been rewarded. Then you look at promoter stakes. Sorry?
This cash flow, right? So, getting the cash flow, is any ratios you out of
I want it to be positive year on year.
I mean, current ratios.
There are, as I told you, I do about 11,000 checkpoints on a
Any
spreadsheet.
critical things regarding the cash flow? Any critical-
No, critical, I would think the cash flow is after dividend is still adding to the cash. And the other indicator is debt equity should be coming down, no?
that is-
Debt equity, debt should be, ideally for most 10-year companies, the debt should be zero in this. The promoter stakes, this is a very pet theory I hold, I don't know whether I am right or wrong. I always find that when the promoter stakes fall to less than 30%, the company performance starts to deteriorate. Unless somebody becomes a very professional outfit like an HDFC or an Infosys or ICICI or something like that. Because Infosys did start as a group of friends and family. But if you look at them, their combined holdings is less. But still they're still doing well. I think ICICI or an HDFC. There are very few companies like that which have built themselves into institutions. If you go to the best side, I think the second generation onwards the promoter holding drops because it goes into professional, so-called professional hands. So here I like to, for me, warning signal is when the promoter holding falls below 30%. Why 30%? Why not 31? Why not 33? I don't have an answer. This is something I used as a back testing for about 200 companies and I found a good correlation. Ownership dispersion to me is important. I think there is some kinds of checks and balances, accountability which makes a difference. And I like to look at the free float in a company, how much is it, what kind of holders are there. And sustainability is something which is, I think, a very broad term I like to use. Whether this business and this industry going forward is, will it be there in the next 10 years, next 20 years? Can I trust automobiles? I know will be there, four-wheelers will be there, two-wheelers will be there. Technology, I am afraid, I do not know enough. So I do not go into that area. So today, somebody may be selling you something, tomorrow the whole thing changes. Like, I remember there was a company which a few friends of mine, we started in 1986, called Worldwide Technologies. We were making the first modems in India. Small modems, and our installed capacity was 8,000 modems. I had to walk out of that partnership because I was against that investment. I said, I have traveled abroad and I have seen that these kind of businesses are very, what you call, commodity-like businesses. Modern capacities are in millions per number in Taiwan. So when you're making 8,000, I don't think we will have a future. So technology is something which I am not comfortable with, how soon it will change. So I prefer to stay out. People who understand it well, I think it's more for them. So the rule from this is that don't do something you don't understand. Just because Bala told you or Patu sir told you or Sundra told you, if you don't understand, don't do it. Or you give him the money to manage it yourself.
Sir, can you give some more example on dispersion, ownership dispersion?
Ownership dispersion is, let us say there are some great companies which are owned 99% by the promoter. Now he will set the share price. In the old days, the shares were subjected to wealth tax. Okay. So you had even companies like Sundaram Finance. They went for a listing because wealth tax rates were lower on a listed share. But the market price was important. So they made sure that if the share dispersion was between known people who would not trade. So the share price was a constant 35 rupees over years. No, I am not blaming them. The system was like this. So what we want, this question is, I want people to see active trading. The physical deliveries on those stocks should be 30-40% of market cap every year at least. So that means that the impact cost on buying and selling is low. Otherwise, there are shares like CRISIL, for example. I am an owner, I must confess. But if I go to sell 1,000 shares, there is a 10% difference in the price. Because the ownership is not very dispersed. There are two large shareholders holding 88-90%. So, well balanced. So, but this is a conscious risk to take. It's still up to you. If you still think that the stock is great, by all means, do it. I made a lot of mistakes in my life. See, some of the mistakes which companies make are interesting. Capital misallocation. What does it mean? It's like the companies like an ITC or a Larsen and Toubro or any number for the sake of once upon a time it was fashionable for everybody to have a leasing company. Then it became fashionable for everybody to have a tech company. There was this company called Pidilite which created a subsidiary, Pidilite Leasing. But by the time the leasing boom was over, when the tech boom started, they changed the name of the company to Pidilite Technology. It was a subsidiary, they didn't do anything with it, but this is the kind of, so if you were to allocate capital to it, see, I invest in ITC, why? I invest in ITC because I think they are the best sellers of cigarettes in the country. And I want to be in that business because it's a recession-proof business, wise business, it has no thing. Now suddenly they go and sell agarbattis, or they put up hotels and shampoos and all those things. It's the same amount of money they had bought HLL and Colgate shares. By now the ITC shares would have been 3,000 rupees. So it's a capital allocation decision. You look at I look at every balance sheet to see what is the invested capital in that business. So the higher it is, the more comforting it is. Or like L&T. L&T is getting dragged down by a subsidiary called L&T Finance.
So you stick to companies that stick to their core competence, not to diversify.
No, if they diversify and they get enough returns, it is good enough.
But okay, what is the patience now? I don't think you can get it on the first year.
No, normally no good company will diversify that easily. You look at it. I don't think you will see an LMW going and tomorrow starting a ready-made unit. Very difficult. You sure?
If you look at the newspaper business,
No.
or if you look at the digital or the film industry business, 20 years back, newspapers were the hottest thing.
Correct.
They were expected to grow at 6-7% year on year to infinity. About 10 years ago, that trend changed. The newspaper companies that are surviving have become media houses.
Fine.
So that is diversification for
No,
survival.
that is actually they are recognize that the business is dying and changing. I will not make a general statement like that, but what I am trying to say is people get into is it because ITC cigarettes have stopped selling, they have gone into this business? No. Or is L&T's machines or their engineering technology going down the tube that they have started a finance company? They started a finance company basically to push their equipment sales. So that is, you look at the GE Capital, the most diversified company, and they had the finance company. Now they are getting out of it finally. Because if you look at the finance or banking business, it has to keep growing and feeding on itself. It stands still and it's bankrupt. And that is why regulatory capriciousness and forgetting global trends. Here I have a very small example. I invested in a company once called Aryan Fine Fabs. None of you would have heard about it. He was one of the forerunners in textile exports, ready-made garments. What he did was he got together about 400 sewing machines and put them together, and he was getting all those contract jobs for putting. I said, hey, this is the future, everybody is going to grow that. But what I didn't realize was that the balance sheet was screwed up, he had too much debt, he couldn't invest in better technology and slowly he died. So the global trend there was that they had very, very advanced machinery using computer technology to cut and design, whereas this guy still had 3 people pursuing machines. I didn't realize that. I was not mature enough or I didn't know enough. So it is important to look at global trends, what is happening. So what is happening outside will happen here also tomorrow. Regulatory capriciousness. Capriciousness is like the regulations keep changing day in and day out. So I am very wary of businesses like that. Where one announcement by a finance minister or an industry minister sends the stock into a dizzy. So as a rule in my portfolio, I do not touch PSUs. Whether it is banks, BHEL, BL, I don't care. I am happy there are enough opportunities outside of that. And size. To me, size is important. Because very small companies can show you spectacular numbers. Only when they start growing do you realize whether those numbers are sustainable or not sustainable. So I like to look at companies which are in the top 3 or 4 for best. Yeah. So size is important to me. Let me come to a company which, this is all in rupees crores, except I mentioned. This was a hot company in 2011 and 12 in the space of technology. Look at the numbers. Can you read the numbers by any chance from Jack? It had spectacular numbers. The turnover had gone up from 850 crores to 2,400 crores. The ROE was 51, 34, 31, 37. Debt equity coming down 1.4, 23, 66, 69. Book value has been increasing, the share price. See, this is enough for most of the lay person to go and buy a share with this screening. So this is where a little deeper analysis, reading the annual reports can make a huge difference. What I found, every year the company was making a QIP, private placement of, it was diluting shares. Every year the cash was coming in. It acquired 10 companies in 11 years, all offshore. And the margins were very, very huge. The company said it was in medical devices. It claimed certain market shares, which I checked with the US data, were totally wrong, that this company was taking it. The year-end cash on hand and debt didn't look, it showed 1,000 crores of debt and 800 crores of cash in hand. Now it is ridiculous for somebody to do that. And company was constantly raising debts. Then I thought, so you should read the notes to the account. Sometimes the auditors cannot escape because with all these legal liabilities now, auditors will put the qualifications whatever they are. I found the market share claims were fake. The rates per employee in high technology industry, they had given number of workers and the salaries at the consolidated. It worked up to 8,000 per month. Then furniture per employee was 24 lakhs. Which was meant I took the gross sum of the furniture and the number of employees. Legal liabilities were growing in the US market. Working capital cycle was 300 days plus. A lot of expenses were debited directly to the reserves. So I went on, and this is an actual one where a fund manager had put a large amount into this. He was very, very happy. I did this analysis and gave it to him. There was another analysis I did on a company called Balakrishnan. Balakrishnan was supposed to make those RFID tags. So what a little bit of Google told me was that RFID tags are sold by the kilo in Taiwan. It is not a unit price, it's a per kg price. I didn't then I found out there were so many obvious inconsistencies. The share, I wrote in Money Life and the share just tanked. All the fund managers got out. From 250, the share is what, 5 rupees today. And the company, so this one was a similar one. I told a few friends, I think you are making a mistake. This business is not here, there is something a problem. This is a company called Opto Circuits. The share was 250 rupees. I don't know where it is now, 25. But the whole thing was a beautiful dressing up. But without reading the balance sheet, you would not have found this out. And reading the balance sheet, one would have found it out. Whatever basic templates we had. It had goodwill, it had patents valued at 500 crores for a 2000 crore business. And overall, it smelled bad with the numbers and everything. So I was advising our family office at that time. We put out a note. They had not invested. This was a pre-investment check because the numbers and all, everybody, there was a lot of noise. So we said, let's go into this. And this, then we shared privately with a few fund managers who were grateful to us.
How did the fund managers miss this? I mean, right now.
No, I don't blame the fund managers. Most of them don't have time to read. They rely on a broker, they rely on a company presentation, and to them it is like a demonstration effect. If HDFC has bought it, I will buy it.
So basically, we are investing a lot more into mutual funds because we don't know much about valuations in equity. We are assuming that the
No, only thing is that diversification helps them to hide it. See, when the mutual funds purposes were small, they could give spectacular returns. All they had to do was not buy Reliance, not buy Tata Steel, and they could beat the index. But now today, with the kind of sizes in each large cap thing, they will end up mimicking the index. They cannot not invest in Reliance, they cannot not invest in Tata Steel. So they will start looking more and more mediocre as the purpose grows. So you are probably better off buying an ETF. This was after our analysis. ICRA downgraded. Analysts were very bullish still because they said it is a one-off thing. They didn't bother to look at this. No dividend in spite of reported. Smart fellows got out. These were some of the companies where I know mistakes. Couple of companies I made mistakes. Karthik Alloy was a Chennai-based company in those days listed on the OTC exchange. I don't know how many remember we had an OTC exchange, which is like the BSE exchange today. So it was listed, it was a problem of size. It had a 30 crore turnover, but it had very rosy. Only thing is I didn't compartmentalize my investment mentally, saying that it is a venture capital investment and not a wealth creation tool. So it bombed. And real estate companies, how many of you have ever bought a real estate stock? 1, 2, 3, 4, quite a few hands. Why? Any idea?
So real estate always goes up.
Real estate stocks?
No, it depends also. What companies do buy? I want Ashana also. It seems to be doing good.
No, see, do you know how the balance sheets are structured in that or the accounting stuff? I have a lot of skepticism about that because I found afterwards that the advanced sales numbers received are actually loans from the financials. They show no debt. But what is done is at the ground stage, when the project is launched, it is sold to a financier who is given, let's say, 50 flats. And if the, let us say in Teenager the price is 18,000 rupees, he will give it to them at 5,000 rupees. So he is hiding a loan, he is hoping to sell tomorrow. So there are lucky people who have made some money also, but by and large real estate has been a fraud because work in progress, how do you value, nobody has any guidelines. So rather go and buy that piece of property if you are so hung up on that. Tech companies, see there is a very interesting theory, I don't know how many of you have read recently, Cisco CEO John Chambers. I think he made a phenomenal statement saying that 10 years is probably the life of any technology company. It will change. So technology, be aware that there is an obsolescence factor. So like Microsoft must have been very hot when it came out. Today it is struggling to grow because it's reached a huge size. So even to grow 5% is a challenge for them. and with more and more open source coming up, it's a matter of time, I think. Same with Apple, how long will it keep innovating? Maybe another 5 years, 10 years, I don't know. But I am not very comfortable, it's not an investment where I sleep peacefully. PSU stocks, bank stocks, I told you that I make mistakes looking at the numbers and suddenly the government policy changes and everything goes quite off. This is another company which is, I think this is a big fraud. This was a company which showed turnover from 1400 crores to 2500 crores. It showed profits from 200 crores to 300 crores kind of ranging. EPS was 34, 43, 39, 37, 19, 45. Phenomenal numbers. So looked at 14, is it one bad year? Share capital is small, 51 crores, the reserves are so much. Share warrants in 2009. So, it looked like not a bad company, maybe not I would buy, but something like that. The warning sign was borrowings, 1700, 2800, 3200, 3200, 4800, keeps on increasing. And look at the sales number, 2000 crores in 2013, creditors 1300 crores. Again, I looked at the sales of 2,400 crores. For the 2,000 crore sales, it had inventory of 4,300 crores. Obviously, I think these are very, very simple things which a balance sheet can tell you. Okay. And the debt also is shown understated in this, which I came from a Google search, simple Google search. This company's name is ABG Shipyards. It is gone in for 11,000 crore restructuring. The debt shown on the balance sheet is nowhere near that. I did a simple cash flow check. I took the current assets, loans and advances, investments. Then minus this, I got a net increase in current assets so much, and borrowings are funding so much, and sales was actually not doing. So basically, the company was doing a cash strip out of the company. Probably all the projects were gold-plated. And then the notes, interest-free loans to relatives, 240 crores. Statutory, when it had cash on books of 700 crores, it showed PF and professional tax outstanding of 70 crores. Delay in servicing loans 2 years. And I went back to history. The promoter's contribution in cash to that company was less than 2 crores. This is another interesting company. The blue chip company. Book value per share in 10 years has grown from 42 to 400. The second line is what is worrying me, second line and the third line. I have drawn the yellow line to show where the change actually the company started deteriorating. The ROE from 30s, it started coming down to 12, 13. This year is, I think, probably close to 30. And on all other parameters, it looks good. It is a company in decline. This is Larsen & Toubro.
You are giving me heart attacks.
That's what I said, the blind should lead the lane. Current market is at 1600. And I took the high PE, low PE for so many years to see what the market fancy is. It has traded at PE as high as 159. And in the recent 10 years, it has not gone below 15 PE. EPS growth 14% declining. 10-year average EPS declining. Average ROC 13 declining. Average ROE 26% declining. It's not a 1 year decline, it's a secular decline.
Like
Many things might change if they get rid of the NBFC. I think that line is when the finance companies started coming in and the numbers have consolidated.
So they're trying to pull it off now.
Good luck to them, they'll find some. But I think I am coming to the end of my presentation. This is very boring because numbers.
No, not at all. Not at all.
Sorry?
So
And what I am saying is,
One more thing I want to ask. How much do you discount this 2008 phenomena across, how much do you discount?
2008 was a great one for me. I bought some fantastic stocks.
Okay, even I bought a lot of
I
stocks,
bought
but
tulips.
Good salesman, I must
No,
compliment.
I bought tulips, yeah.
how do you kind of see that everything tanked? I mean, everywhere there is a global gloom, and then slowly things start to pick up, and
See, I don't worry too much. I read a lot about it, but it doesn't really bother me. I am at 60 now. Will I get another chance to buy equities? This is what I look at. Not that I have too much of spare cash to buy, but I would still like to see something coming down. Maybe I'll buy 200 shares somewhere. But it's still not happening. What is now suddenly visible is now people, I think the smart investors are hanging on to the high quality companies. Even in a bad times, those shares do not tank. So if we get fewer and fewer investment opportunities, we get a lot of trading opportunities. And I was looking at a company, I don't know how many of you are familiar with the company called Infinite Computers. It is among the top 10 companies and everything. Phenomenal numbers, everything matches, the management scheme. But this year's result came when the share went from 280 to 130. So, is there something which we have missed? I don't know.
So in the technology space, do you differentiate between product-based companies versus services-based companies?
I have not seen product-based companies in India.
No, in general, in terms of Infosys might be acquiring quite a few in future.
See, acquisitions I am not generally a fan of. It's a very, I think most of them do not work because of cultural misfits. Maybe it's, somebody, if a TVS is buying a auto ancillary company, that's very different because they are buying it to absorb technology and it can be replicated with local labor at Hosur or wherever. But when in technology space it happens, technology space is more people driven.
Right.
So I don't know. I don't know enough to make a valid
Did you own any of the service oriented companies of technology? I mean, like Infosys, TCS? Never.
No.
Never.
I was always too scared.
Too scared. Okay.
Or too smart.
When I am saying, if you are building an equity portfolio, you go back to Warren Buffett, he says investments is like somebody has given you a ticket with 20 punches. So probably that is the number of stocks you might buy in your lifetime. So you don't have too many mistakes to make, so do a lot of homework. Make good sized bets. Put 5%, 8% into some stocks, not 100 shares or 200 shares, I would say, depending again on your, because if you have 50 stocks and you put 1% in something, it goes to 5 times, it's not going to make an overall impact on that. And too much of diversification, you will get Sensex returns. How much everybody asks me is, it depends on how much is your level of comfort. I am happy with 5, somebody is happy with 10, somebody is happy with 15. I would think somewhere around 50 should be where you should draw the line saying I want, because I don't know whether I can track more than 15 stocks. And corporate longevity is declining. This I had made the remark long back. Now I think Mr. Cisco has mentioned that because the way delivery mechanism, see today a big basket is emerging. Tomorrow there might be some other method of delivery. So where do you go? You go to somebody who's making the product. And keep worrying. I think I always like to worry a little bit about whether I should take money off the table or not. There's no harm, because if the retirement plan shows exactly at the age of 60 I can draw everything, then here Ajay Mehta, Ketan Parekh or Patabi or Bala may be creating a scam in the market. And your 12% return might have cracked to 4% return. So cash your chips a little before you need them, when the thing is good. How do you use, I use something called a PE band. which is, I see historically, let us say Hindustan Lever has traded in a band of 50 and 20. So to me, it means if I have to buy Hindustan Lever, I should buy it closer to 20, and if I have to sell it, I should sell it closer to 50. It doesn't mean that the stock will go below 20 or above 50, but that is a kind of a comfort zone. Historically, 10 years has been established for me. I am using a wrong thing, which is a trend which, but to me that's the only tool available as of now. So to cash some things, I cash a little in advance. I don't say I have to make a build-up payment on 13th July, so I will sell my CRISIL shares on 12th July. On 12th July, the share might have cracked. I'm happy to do it a little in advance. And don't worry once you've made an investment unless you have made a mistake. And last is wear your pants one leg at a time. There is no hurry. It is not that the market is going to run away. Somebody says, I get call from HDFC Securities. Sir, buy this share today, tomorrow it will go up 30 rupees. I don't know how to buy this share, right? I don't know that share, let me understand it. But sir, tomorrow you won't be able to buy it. I won't buy it. I am happy.
So I have only one question.
Yeah.
You said whenever the market tanks and cracks, there's a time for the stock trade. So as of now, we will
Don't look at the market to tank.
No, I mean the industry as sector.
No, I am saying you make a wish list of 10 stocks or 5 stocks which you want to buy. Keep that in your dashboard anywhere you go. Keep tracking those prices. So, like I said, Hindustan Lever, I am happy to buy at a PE closer to 20. If for some reason it cracks, it comes down to 25 or 28, I will start buying that. I will do that. I don't look at the index and do that. Unless I am buying an ETF on the index.
Now the commodity is not preferred nowadays.
I don't understand commodity.
Okay, I mean not the commodity in the sense. So the metal stocks, are they in your radar now?
No, I had a last case study was on Hindalco showing that a bank deposit is about 20 cents rupees into it. Sorry? Sure.
In your YouTube thing, you mentioned about understand the business before buying the stock.
Correct.
So, see, we are not like in CF.
No, I understand, but you see, it is not if you want to buy a stock, understand what the company is buying and selling, understand why it will make money. If you don't understand it, don't buy it for God's sake. That is what. See, I am saying you take a simple thing. I will give you 2 books to read. One is Competitive Strategy, Michael Porter. Read that. I still hold that as a Bible. And you can use Benjamin Graham's book. And if you want to learn how to have basic analysis, simple analysis for non-finance, there is a book called How to Read a Balance Sheet. It is an ILO publication with an Indian one. Last I know the price was 100 rupees or 75 rupees. Those 2 things you read, you will understand a little bit of basics. As I said at the beginning, you spend 10 hours, 12 hours earning a money. I think you must be practicing how many hours? 12 hours. So, spend 1 hour about all that money you earn in that. I think you might become a better investor. If you are not comfortable, don't want to be a cowboy, stick to mutual funds. I think they are safe.
ETF.
Sorry?
See, index fund comparative to index asset fund for the ETF.
I don't know, it all depends on personal preferences. I think my belief is I am happy with an ETF. If I have to invest, I have never invested in an equity mutual fund. I have used mutual funds only for liquid funds.
I mean, your equity, I mean, what is the maximum allocation you have given among your financial assets? In very bullish, like,
Financial assets is 100% for me.
among that,
No, but see, I started saving at the age of 41 or 42. Till then I had nothing, I was spending more than I earned. And as I said, we never saw those 5 lakh checks and 2 lakh checks as salaries. So we had to grow with what we had.
yeah.
But if I look at today what my purpose is, so 2/3 is because of what it came from equity. And 1/3 is from property. Property returns are slightly below savings bank.
Among your financial assets, you still keep a big chunk in equities.
Yeah. The liquid funds may be 10%.
Oh,
That's what it is.
okay, 90s.
Yeah.
Sorry?
Sorry? Michael Porter. And second is how to read a balance sheet. And the value investing, you read, value investing, if you want to read a more modern book, you read one by James Montiel. I think you will learn a lot more about behavioral economics in the session later. And I am a fan, I am also waiting for that.
One of the blogs, has posted like Indian markets are unusual, so maybe
Sure.
So in Indian markets, like it's not matured as US, so this Nifty and Sensex is not as affecting the actual.
Correct.
So in that way, the ETF may not be like as good as if you are going for HDFC top 200 or blue chips.
I don't know, I think we can have opinions on that. I think this is, I don't have any scientific basis to say what it will do tomorrow. Going by past, it looks like HDFC growth of 200 has done better than the index. That's because I think they started small and it was very easy to read. I think it's becoming more and more difficult.
Would you recommend Peter Lynch?
Sorry?
Would you recommend Peter Lynch?
They are all good to read. I think it depends on how much. There is never enough to read. As I said, I did a Google hit on value investing. I got something like 3.5 crore hits.
Today,
And I did on stock trading techniques. I got something like 45 crore hits.
Sir, on the sectors like you knocked off banks, you knocked off real estate companies, etc., technology. Which one you prefer? Which
I
is in
think
your
being
heart?
in India and having to make money out of Indian stocks, I like to look at where your children are going to spend money tomorrow. Think that, and that is where we will be the money, where is the spend going. So let's say everybody is going to buy a house. So does it mean real estate? No, there are better proxies. Buy HDFC, buy LIC housing. They are the ones who are going to give you loan. Sometimes 110% also.
We can look at, in that angle, we can look at this Jubilant football, sir. Like,
Sorry?
they're going to eat pizza, they're going to have pizza.
Who?
The Jubilant football. We can look at
Jubilant football. Jubilant football. I think it's a very, very hot and expectant market. So I am not invested in it. I don't like the numbers. I think it may not grow as fast as the analysts think. I think that way I missed something like paid industries, I must say. I got into the wagon very late, but when I missed the 0 to 10, missed that.
question. So, Page Industries is like a 10x. I mean, if you look at, yeah.
So 48.
So, but if you were looking at stocks in a PE band, a lot of people started exiting when it crossed their threshold band.
Probably I would also exit it by now if I got in early. I think it depends on one, your returns you are happy with. Two, if you have another investment which is attractive. So you don't have to be 100% in there. I think you keep cash with you, never invest 100%, invest 50%, 60%. Keep money for buying opportunities. It will come. And this is what, don't give on hope. Beware of forecasters. I think the stock research analysts make the astronomists look good. Learn to take losses. If you make a mistake, get out quickly. This is for history repetition. I think only in history books, because a lot of technical analysis is based on history. I am not a fan of it. Keep liquidity. Don't be loyal except to your spouse. And don't forget to live. I think money is aim for that.
When you say keep liquidity, I mean how much you keep, even in a 2008 scenario when everything tanked and you saw a lot of opportunities.
2008, I think by 2006-07 I was almost 60-70% in cash.
In cash, because everything hit your threshold and
Yeah.
so if
See,
you
even today, the portfolio which we advise at the family level is almost 45% in cash.
because of the levels.
It's a large, it's a 1,000 crore portfolio.
So when we say we invest on companies, suppose like Page Industries, shall we look at the second company, the third company?
Why do you have to, I think don't look at the rearview mirror, you will only get what you call as I don't know what the right word for it
No.
is. Bitterness in planning, saying, oh, but then you'll make more mistakes. Don't look at that. I think still look at page again. If you say, keep it on radar, say that if it comes to the, I will buy that. Why do you want to go at whatever the Lady Lovely or whatever this other second stock is?
Sir, I have a question. Like you said, like it's better to purchase when the markets are low. I mean, so what about equity?
Just buy the beer. Just the beer, not the stock.
I have no answer for that. See, these businesses are fundamentally not viable. Why do you want to chase a rumor, go chase it, make your money and get out? These are like trading opportunities which you get in and get out. You want to buy global offshore because somebody is going to tomorrow go and buy that company, it's on upper circuit every day, go buy it and trade it and get out. Forget it, don't. So keep your compartments for investment and speculation separate.
I mean, do you do that?
I do. Now I'm retired, I have a lot of time, I do a lot of things. I still to make money. So when I make 50%, I'm very happy.
How much of your portfolio you use for trading?
I use a small amount of about 5 lakhs. It's not small, it is a reasonable amount, but today I'm not finding, but the day I find an investable in one of my stocks, I will add it. This is keeping myself busy. I can manage to live with my current income, so I don't interfere too much.
So your kind of a universe of 10 stocks, you keep entering, exiting depending on the
No,
value.
I don't. I'm very lazy. Because my fear is, let's say I want to listen. If I look back, it went to 2300, today it is 1900. So logic tells me I should have sold at 2300 and bought now. But my fear is I will sell there. At what point do I sell? Will I buy it again or my
You have
say,
certain,
you go and buy another house?
you have certain threshold that if it crosses some P, like HUL you said, if it goes beyond, then I want to sell.
It is still not in that. I don't want to sell. I am saying if I have to sell something, I will pick up something which is closer to that line.
Oh,
Otherwise, I am not too
Not
much
too-
worried.
okay.
I am not too much worried. I know my NAV will be a
yeah, okay.
lousy chart. But
So you really have some things that are buy now and hold it.
something are,
Yes.
yeah.
Coming to this business cycle,
Yes.
Good one.
so I'm just regarding the business cycle, like suppose for example tea industry, sir, it's a little bit down cycle now. So
They are trading opportunities, tea, sugar. These are not companies we are ever going to invest because the government policies, the commodity cycle make sure that, because they have not only cyclicality, they have seasonality also. I see newspaper reports saying the sugar shortage, suddenly sugar stocks will go. Why will the sugar manufacturer ever keep money on the table for the shareholder? No. So they are trading opportunities and recognize them as such. You don't buy and keep it in your portfolio for long.
So one question I have. The page industry, what you said is at PE 10 you missed it and then now it is going around 40 PE. How do we judge what is the right PE at the moment?
We don't judge at this moment. At this moment, I can only say that if there is a disaster in a quarter and let's say the price cracks 50% or something, I might put some money in there. See, in any stock like this, it's a risk to me. Because I still don't know whether it is as solid as a lever or something low. I think people are saying that it is of that quality, there is a good management, everything is being said about it. So if for some reason it has a bad year and it cracks, I think I would like to add some to my portfolio.
How much do you value dividend yield? I mean, consistent dividend yield.
I look at dividends.
Okay.
Dividend yield is a function of market price.
Maybe you are not looking at Reliance Industries, but the dividend yield might be improving because the share price is in a narrow range. Do you look at those kind of?
Not really. But in a bad times, if you have got money to invest and you are chasing a theme, maybe there may be stocks at 5 to 8% dividend yield which you might like to pick up. But then is there a guarantee that it will give you dividend next year? Is the stock like that? If the stock is of that quality, then it will not trade at that dividend. Let me tell you.
Things like NMDC, for example.
I work in such a government company, I told you, I
Yeah.
don't like.
Actually, the companies like MRF, they don't give, they don't split shares or give bonus shares. So how do you see like?
I have it in my portfolio, so I'm a very happy person. And I'm very happy that, see, the problem with that is the poor liquidity means that when you go to sell, in your mind you keep a 5%, 10% haircut. So it is again, the price should not deter you. Like if you look at Berkshire Hathaway, it is at what, a few $100,000 or something.
200,000.
It is again management. Why they don't want it? Probably it's the management doesn't want it because they don't want too many guys trading the shares. They are very happy.
But
They would like to delist also.
in India, you can't buy.
Investments in like corporate restructuring measures.
That's a very specialist task, sir, not for you and me. Unless you are in that field then.
So no more questions. Let's thank Mr. Balakrishnan. Ask Balaji to a small token of our.
Hey, thank you on the matter.
It's our honor that you are.
Hey, it's my pleasure to be interacting.
So we have a few more minutes for lunch. If you have a couple of questions to ask, you can ask any of the three
So
speakers.
can you just tell what are your top 5 holdings? Sir?
And sir, and that will be followed by the last 4.
If you can keep that off, I can.
Done.